Yeah, I mean, so I sit in all my clients' board meetings, and I hear a lot I hear a lot from investors in terms of what they're seeing and what they're thinking. I think, unfortunately, and this is just my prediction, I think 2024 will be much of the same. I think it's going to be another kind of slow year, but I'm optimistic that kind of in Q4 we'll sort of start to climb out of this, and I think 2025 is going to be a good year again in the tech world. So that's my personal prediction.
Okay, and so I guess you probably answered the question. So that's fundraising, but what about exits? When the hell are we
Ah,
going to get our money back? Because because people kind of say like, well, if Zoom was valued at 47x revenue, like it would take you 47 years to get your money back with no discount or time value of
right,
money. I mean, that's
right.
insanity. But that they're afraid of selling at these lower current market multiples. When do you think that we're going to see sensible M&A or even, what are your thoughts on IPOs for 2024? We've got like 60, 70 portfolio companies. I would love to, start returning the cash and stop talking about the total value to paid in.
Yeah, I think probably a similar timeline. I think we have a number of companies, some of them are our clients who are kind of eager to go public, and they're keeping things warm so that they're ready to go. But I think most folks think it's like at least a second half of Q4 of 2024 thing. So I think you'll see a similar timeline for M&A and capital markets activity.
Okay, so maybe a good time to be investing now
That's right. Yeah.
we're not that far. Hello and welcome to Fireside with VC. My name is Andrew Romans, and today we're with Kristine Di Bacco, who is a partner in the corporate securities group at Fenwick, one of the top major law firms. I always say to startups, be innovative if you want with your technology and your business model, but don't get overly innovative with your legals when you're fundraising or doing anything. And Fenwick is clearly one of the top firms. So this is part of our legal series, and we're going to dive in today. We might talk about anything and everything, but I want to focus a little bit on things like some of the difficult financings that are happening as the kind of valuations and bid-ask discrepancy is finally coming together as the system flushes through with certain kind of pay to play and kind of some of the negative sides. And we're going to touch on securities. But Kristen, thank you so much for making time and joining us today.
Thank you. Really happy to be here.
Yeah. So Kristen is both a JD and MBA, so law school and business school, which I think is great for the corporate securities world. Although most of us kind of pick up the other side and can play it on TV, but she's got those credentials, which is great. She's actually active with Cornell, one of her alma maters, as a frequent guest speaker. She's in the Menlo Park, Silicon Valley office of Fenwick on California Street. I've been in that building many times, but she also is one of the founding partners of the New York office of Fenwick, which maybe we could talk about that quickly. It was 2016 when you opened it. How many lawyers did you start with, and where's the practice at now?
Yeah, that was a really, interesting opportunity. I think when you're a partner in a law firm, you don't get the chance to build something too often. And so we had decided as a firm to open an office in New York. There was a lot of market activity there. We also thought it was a good recruiting platform. So I was asked to go, I was working in Silicon Valley, living in California at the time, and was asked by the firm to go and help start that office. So kind of wasn't on my life plan to live in New York, but it was a really unique opportunity.
Had you
So
ever
we
lived in New York
started,
before? Had you ever
I
lived
had
in New York?
not.
So,
No,
I
I
mean,
hadn't.
everybody should live in New York at some
Exactly.
time. Yeah.
Yeah. So we started the office in 2016 with 6 attorneys, 2 paralegals, and we had tremendous growth. The office today is, I'm told, about 125 attorneys, and
Wow.
I think 175, including staff. So I was there for 3 years, which were, I think, some of the key formative years in getting that office going. But it was a lot of fun living in New York and starting that office.
Yeah, living in New York is amazing. Leaving New York is also something when people leave New York. But
Right.
it's funny. We're talking about this privately. In the dot-com days, I was very like it used to be that New York was a flyover state to get to Boston. Like so, Boston was there was more venture capital funding in Boston. Boston was always kind of number two after New York. Probably in like ancient times of robber barons when there was no 2 and 20, it was just like rich families. New York was
Right.
where you got your funding, to, send your ships around the world. But as venture capital really matured, it was Silicon Valley number one, Boston number two, and New York, strangely, was like didn't have the patience for this patient person's game of,
Mhm.
invest now and get paid decades later. But when the dot-com thing was taking off, every investment banker was ripping off the tie, getting like a foosball thing in their Hell's Kitchen office and saying, we're venture capitalists. And then poof, they disappeared when the
Right.
meltdown happened. Whereas like, Hadley from ENIAC told me that my firm, which was Rubicon Venture Capital at the time, in 2010 was one of only 50 VCs operating in New York, which is almost hard to believe. By like 2016, when you opened that office, things were really, every investment banker again was taking off the tie. I'm done. I'm going to retire from Goldman Sachs and start FF Venture like John Frankel. And it was just
Right.
fund after fund after fund. And now there's too many to count. I mean, it's in the thousands,
Yeah, and I think New York's a really interesting market. So my practice is pretty bi-coastal, and even though I live in California, I still spend a fair bit of time in New York. And I think there's really interesting companies getting started there. Interestingly, I think there was a day when you could be presented with a term sheet and you could tell, oh, this is an East Coast venture capitalist, right? The terms look different. But I think one of the good developments is that terms have really aligned, and I think the New York terms have really, they sort of now match Silicon Valley terms, so it's impossible to tell the difference most times. So I think that's a good development in New York. But yeah, I think it's a great market, good investors, and lots of interesting companies getting started.
Yeah. And there's a lot of the big name firms, like kind of top 10, 15 firms that sent Silicon Valley people like you to New York City. And I remember like even trying to give deals to those guys so that they show up on day one with a good venture back deal, to show that, they have a network in New York or something. Yeah, we'll talk later about secondaries. I'm curious to hear what you think. I mean, I was a founder. I'd raised over 300 million for my own ventures. And when you're on a founder salary, you just got to put everything back in, all the retained earnings back into the company, going for growth, path to profitability. The idea of the founder paying herself a big founder salary just doesn't really fit into kind of the algebra equation, right? And so when secondaries were kind of happening, um, I felt like the West Coast was more compassionate, understanding, and a lot of the VCs on the East Coast had never really been operators. I mean, even Fred Wilson, greatest VC to come out of New York, has never founded a startup and raised venture capital himself. He's always been on the other kind of banking side of the table and the VC side of the table. And so I think there's still a little less compassion for secondaries. And I'm the first to say secondaries can be a bad thing for, when are we going to IPO now that she's got 30 million out of the deal? She's in no rush, and it'd be nice for us to put some points on the table, make some distributions, and all that. But that's one of the first places where I see differences between New York and Silicon Valley. Maybe another one I see is valuation. Like, like we had a company that went from zero revenue. We introduced them to actually Ericsson. They just had some POC revenue. And then all of a sudden Ericsson was paying 5 million a quarter. So we're on like a huge revenue run rate. And the East Coast guys say, let's raise 100 million on 500 pre. And, so like you'd have to sell the company for, kind of 2 billion to satisfy these new investors to get a 4X of the post. And on the West Coast, we're all like, well, maybe we raise 10 on 40. So the number of buyers that'll buy this company at 200 is limitless,
Right.
Where you're leaving yourself, there's only one way out of this burning room with no doors and windows, and that's an IPO.
Yeah.
So I mean, I feel differences all the time, but we're very much on both. We've had offices in both San Francisco and New York for the last 15 years until COVID. But listen, the topic you and I were talking about getting into today are when everything's not going swimmingly well up and to the right, and you're just going from strength to strength, and the market is consistently getting increasingly bullish about your business. You hope to raise a larger funding round at a larger valuation. All the existing incumbent VCs are happy to see their share price go up, and so their unrealized paper TVPI numbers are looking great to maybe raise their next fund on that, but there's no distributions. And the founder says, I'm getting diluted, but my diluted percentage is worth more as the pizza pie got bigger, right? Why don't you talk us through the other side of fundraising when the market is, going in the opposite direction? Maybe the business is not flying off the hook. They've been spending too much, or, there's a big difference between where we are now and where we were in 2021. So maybe talk about why what are some of these sort of remedies? Like, what are they called? What do they look like? And we'll go through into some details. And when is it suitable to use them? And it's even worth saying to some people, when do you not? Like, some people say, oh, it's time to do a pay to play. I'm like, why would you screw the early stage guys that are not multi-stage? That's not the right thing to do.
Yeah, no, sure. And there's a lot in there. I think as a headline, we are in a very tough fundraising environment. I have lots of companies that are good companies, strong teams, and they're having trouble raising. I think even for good companies, it's just taking longer. So it's a very tough fundraising environment. It's not quite as bad at the early stage. I think there's still a lot of seed and Series A deals getting done, less than we saw, of course, in the heyday of late 2020, 2021, but more activity there. I think you see a really big hit at the later stage. Most of those late stage companies just can't raise on decent terms right now. So if they can just, they are doing that. But where do you see it? So, when you think about tough terms for companies, I think of them on a spectrum, right? On one end of the spectrum, easiest to digest would just be, look, we are raising at a lower valuation than we'd expected. Maybe it's even a down round, but we're able to raise on clean terms. And it's just a function of, an adjustment in valuation. That's probably the cleanest thing we're seeing now for a lot of companies.
So either flat, like flat, sometimes people say flat is the new up. It's like we're joking about, orange is the new black. So like flat is the new up and down is the new flat. But so what are you seeing in flat financings? Like, we've doubled revenues, but given the market, we're having everybody re-up at the last valuation. Is that pretty common, or?
That is very common, actually, and you're seeing it in a couple of ways. One is a new investor coming in and just raising at the same valuation as last time, which I think a lot of companies actually see as a victory. The other thing is, where companies can do it, they're raising just inside capital to tide them over until the market is better.
So existing investors throwing money in. So don't even talk to outside investors. Let's all go in maybe at the same price as the last round. I mean, some VCs. I like to think of myself as only in the interest of the survival and self-actualization of the company's potential, which would translate to the ultimate return for our fund. But a lot of VCs are really afraid of marking down. They don't want to mark down. And so there's a bit of the incumbent VCs are often pushing for a higher valuation than there should be. And that might even be flat. But if it's all insiders, it's practically a rights issue, right?
I think that's right. And you just need to make sure that you give people an opportunity to participate, the terms are fair. And some companies are doing it through like a note or a safe. So convertible note or a safe, that's the other way to do it. So you can punt on the valuation and until the next round, but still bring some capital in and let the company continue to grow until the market is better, whether that's, late 2024, hopefully 2025. So I think that's a pretty typical playbook we're seeing these days. For companies that do need to raise and can't wait that long, or just want to have the security of additional money on their balance sheet. So that's, I think, kind of one end of the spectrum. The very other end of the spectrum is what you mentioned, right? The sort of down round pay to play, and we can unpack that, but that's a very complicated, nasty transaction to navigate. And then in the middle is sort of what I call, not a full pay to play, or down round, but some enhanced deal terms. So somewhere in the middle, which is investors getting maybe a senior liquidation preference, maybe even participating preferred, enhanced governance rights, greater board control, those types of things you're seeing as sort of a middle ground where investors maybe aren't going to, do a nasty pay to play, but they do want to make sure that there is more downside protection and more governance control for a company.
And Kristen, I want to break these down a little bit because each one of these deserves a bit of time since we have an expert like you at the table. So on down rounds where just simply the valuation is lower, what are some things to think about? I mean, like if you've got outstanding convertible notes and safes, that can kind of sneak up on you. Anything to look out, or I mean, you've got the perspective of the founder. Assuming that's the founder is still the CEO, incumbent investors, new investors. What are kind of like the five forces Porter model look like around that kind of thing?
Yeah, lots to think about. I think one is you want to make sure this transaction is defensible to your existing cap table, right? To the people already who are stockholders in the company, because a down round can be very dilutive, especially if there's an anti-dilution adjustment that kicks in, for example. So it's dilutive. And so one of the things that investors keep their eye on is when all the dust settles and the new money comes in at this lower valuation, how much does the key team, the executive team and other key folks at the company, how much of the company do they own? Because what we almost always see with down rounds is some sort of option refresh for the key team, meaning you get a little more equity into their hands so that they still feel motivated to show up to work every day and build value. And investors understand that that's just what you need to do, because the investors only benefit when the team is motivated and can build value. So refresh grants to the team are a very typical term of many of these down rounds.
Right. And there's going to be like a new 409A, and options could have been deep out of the money for, the whole hired team. So there's some issues there. And you talked about, explain the difference for our listeners of participating preferred and non-participating on liquidation preferences.
So in good times, we almost always only see what we call 1x non-participating. So what that means is the investors who hold preferred stock have a 1x non-participating security. And so what that means is on an exit of the company, right, when the company is ultimately sold or goes public, the investors choose between taking their 1x, which is their original investment amount, 1x that amount, or they forego that and they convert to common stock based on how much of the company they own, and they participate as common holders. So it's not a real choice, right? In a good exit, they will forego that 1x, they'll convert to common and participate based on whatever percentage of the company they own. But in a kind of crappy outcome where there's not enough money to go around, investors will rely on their 1x and try and recoup, some or all of that. And so that's their downside protection. 1x non-participating is very market standard, but we are starting to see some participating preferred. And what that means is investors can double dip. They get that, 1x off the top, or 2x or 3x, whatever's negotiated. And then they also then convert to common stock and participate in the sale proceeds based on how much of the company they own. So as an investor, you might think, oh, that's great. Why wouldn't I want to have all that cash come to me? It's a problem, though, for the common stockholders and the team, because it means a lot of money has to go out of the company before your common stockholders, which is your team, realizes a benefit from the sale. And so it's very demotivating to them, because the dollars in terms of sale exits that you need to reach in order for your team to realize value become very, very high. And so it's very demotivating to the team, which is the reason it's not a standard term. But we are seeing a little more of it these days. It's kind of one of the terms that starts to creep in a bad market.
What percentage of deals being done in, say, we're recording this on the 21st of December, 2023. What percentage of deals in October, November, December right now are you saying that have participating preferred?
Yeah, we publish a venture capital survey every quarter at Fenwick, and I can check, but my gut would tell me it's still probably sub 5%. It's still a slim minority.
Sub 5%.
Sub 5, yeah.
Yeah. I raised most of my money in the 1990s and early 2000s as an entrepreneur, and participating preferred was just the way it was. And so carve-outs were common. So if like let's say you're the founder, I'm the VC, we end up with a liquidation stack of $100 million. So we've invested a little bit more, and now there's a 1x liquidation preference. God help us, some like farmer comes in there from no middle of nowhere and gets a 2.5x liquidation preference, which radically lowered maybe the pre-money valuation. These are kind of like two levers that go hand in hand. If you want to go above 1x, then you're going to massively impact the valuation. And the more you get out of the valley in New York into the provinces, you'll see this kind of happen. But what happens there is that, like, if you have an offer to sell the company, it's been 9 years, or God help me, 12 years since our entry point investment, and the offer is to sell the company for 50 million, and the whole Bunsen burner science experiment is not working, and it's like we're in a whole different business than the one we had all bought into, that maybe getting 50 million back is a great thing. But for you, the management, you're saying 100% of the exit consideration is going to go to these worthless roadkill VCs. And we, as the
Right.
real team doing the work and the real talent, will get absolutely nothing. So why should I even tell you about that? Where if we give you a management incentive plan or a carve out of like 10%, 20% of the exit, then you're like, maybe we sell this thing for 10 million, take our 5 and move on. And at least I got 45 pennies on the dollar back, as opposed to 10 more years going by and never even heard that Microsoft, consider it. So these are some of the dynamics of having
Yeah,
this, and not
it's
a
a great point.
toxic liquidation pref.
I think I've done 5 management carve outs in the last 6 months. So
Mm.
it's a pretty common tool that people are using these days. And you're exactly right. It's almost always 10 to 15% of the proceeds that you see. And it's a good tool for companies that are trying to shop themselves, because there's often nothing or very little in it for the team, which is who you need to go and execute on this deal.
A lot of people, especially when I grew up with like being on the founder side of the table, then on the advisor side, and then on the VC side, you're like, oh boy, these VCs really get it coming and going like Tony Soprano. But let me tell you, a lot of times when it's not going great and some private equity buyer comes along to buy like my portfolio company where I'm the VC, they want as little money as possible going to my fund investors, my LPs into my fund, and they want to maximize the golden handcuff incentives for the founders as they transition ownership from us to the PE fund. And in a straight up M&A, it's sort of the same thing. Microsoft wants to buy this company for the lowest possible amount, and they want to optimize the success of the integration and the combined M&A DCF of the whole business together, right?
Mhm.
And so there's sort of like a lot of humans getting in the way of things, trying to stop cash going to us and maximize almost sign on bonuses of millions of bucks for the founders, and we're not even getting made whole. So, if these participating preferred things look rough, I kind of think, believe me, in reality, it's very easy to get screwed if you're not careful, or just bank on it happening. That's why you need a few of these exits to really be tremendous to make up for all these other little crappy difficult things. Okay, so you answered the question on prefs. And 1x, are you seeing anything above 1x pref these days? We're starting to on some of these notes.
Yeah, we on the convertible notes for sure. You're seeing typically like 2x typically, upon a change of control before they convert. But in terms of preferred stock money coming in, I think you are starting to see some like 1.5 and 2x, but still a minority. But because I think the challenge that founders have, and you sort of alluded to this earlier, Andrew, is it's a balance, right, between cleaner terms and a higher valuation, a lower valuation, or messy terms or structure, as we call it in our world,
Mm-hmm.
and a higher valuation. And so those are often trade-offs. And as a founder, you have to balance those. I'm a proponent generally of erring on the side of a lower valuation and cleaner terms, because I think that generally does better for the founding team on an exit. It also sets a better framework heading into your next round of funding, right? So if you raise now with all of these funky terms and we come out of this bad time, that those are still that's precedent on the books. And your next set of investors usually, they want at least those terms. They're not going to,
Mm.
usually take worse terms. So it's a balancing act for founders between valuation and terms for sure.
I would agree with you. I think that all this stuff is complicated, and so the conversation we are having is, I think useful for people that it's better to learn this before you make an irreversible decision. Is basically what this is about. But I think the founders normally are like born like in the hospital birth room saying dilution is bad, and the only thing they're thinking about is dilution, and so they're thinking the higher the valuation, the more I will own at the time of the exit of this business. Whereas if the
Sure.
valuation's too high, you're almost setting an impossible mission for yourself to have a flat or up round. And you really want up rounds with clean vanilla 1x kind of terms, in an ideal world. And it's a balancing act of make it attractive, but don't get too diluted. And position this fundraise as not your last fundraise usually. I think Dave McClure put in on he said like keep it simple convertible note. I think he had a 2x premium on the principal plus interest on any change of control if
Mhm.
there's an acquisition before the next bona fide financing would trigger conversion of the debt to equity. What do you think about? Why don't you give us a comparison of pre-money and post-money safes? Just quickly. I mean, we could spend hours, but let's go through fast. Pre-money and post-money safes. What do you think is best for all parties? And what's the difference between a convertible note and these other instruments? And
Yeah,
when are
maybe
they better?
let's start there. So, when I've been doing this a long time, the safes only came around, what, 6 or 7 years ago. I think Y Combinator, put them out there.
Yeah.
Before that, we only did convertible notes, and they were usually the better of a pre-money valuation or a discount. Y Combinator came out with their safe instrument. Wasn't perfect in the beginning. It's come a long way, and it is by far the most dominant, non-priced instrument people use, and they're easy to use. They're on the YC website. They started out as pre-money safes. They are now post-money safes, and there's two formulations on the YC website. One is discount only, and one is a post-money cap. So that's where the market is now. In terms of the difference between pre and post money, investors like post money because they know what their ownership will be of the company immediately before the new money comes in. So it's the amount of investment that's come in over the post money valuation you agree on, and that would be your ownership interest before you're diluted by the Series A, let's call it. With a pre-money safe, you agree on the pre-money valuation, but to the extent the company raises more money on a convertible instrument, the pre-money doesn't get adjusted. So you actually don't know exactly what your ownership interest will be heading into the next round of funding. So as a general rule, companies like pre-money safes because it gives them more flexibility to raise a little bit more money without the dilution. And I would say most investors like the post-money formulation because there's more certainty. But the market is really at a post-money formulation.
Yeah.
Most deals we get done on post-money.
I've heard founders express concern that they didn't understand what their ownership was or what the cap table was even at with the pre-money safe. And so the post-money safe brought in more certainty of where are we in our journey of going from owning all this company to getting diluted with bringing on investors onto the cap table. I guess when I first saw the safe, I thought a real big positive thing was they removed the maturity date of the return of, that on a classic promissory note, the convertible note, the investor can demand repayment of their investment on the maturity date. Like I remember 18 months was quite common,
Yeah, 18 or
or
24 months. Yeah.
24 months was common. And what would often happen is the CEO emails all of us and says, I need you to sign this little DocuSign to extend the maturity date. Right.
Right.
And we're all happy to do it. And then there's some, person from Arizona that's kind of new to all this saying, no, 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 I've decided I want to take my money back. And you're like,
Right.
well, first of all, we don't have it.
Yeah.
And second of all, no, but
Not how this
it's,
goes. Yeah.
so it was sort of the tourist investor was excited about redeeming or getting maturity date payback. So when I saw the first safe note, the first thing I thought is, oh, this is wonderful. All those people can get in line and we're not, you get your money back if it hits, basically. Come on. But they also removed the interest rate, which I personally think the interest rate is a fair thing that says if we invest and we have a 20% discount, or a cap, whichever's better, and it takes 5 goddamn years to get benchmark capital to pull down a Series A after they're done pivoting around constantly, that we deserve something. And so if I put $100,000 and the interest rate was 6%, then if it converts after 12 months, $106,000 converts at either the discount or the pre or the cap. And if it went on for 5 years, it compounds. So the CEO's got a little bit of a motivation to not just leave this thing out there in convertible note world forever. And, and start the clock on QSBS, if nothing else. That if I can go for 5 years, with issued stock, we pay basically zero tax on the gain, including our LPs in our fund that are US taxpayers. So the interest rate disappearing is one thing. The maturity date disappearing is another. I kind of miss the interest rate, and I think that it's not just greed, like I want to make more money, but it's to say like you shouldn't be living in convertible note world forever. and raising $15 million rounds on a note. You should be motivated to have a bona fide financing that triggers conversion and put us all squarely on the cap table. And we can vote too. If there's something really weird happening, all these promissory notes and convertible notes and safe notes get zero governance unless you otherwise, baked it in.
Yeah, you're exactly right. The interest rate and the maturity date are the two big differences between notes and safes. But the other is really the treatment of these instruments in terms of a liquidation or from a tax perspective. So the interesting thing about the safe is that YC's view, and I think the view of most accountants and investors, is that it is an equity instrument. And so your long-term capital gains clock and your qualified small business clock, QSBS, starts on the date that you acquire the safe. And so an interest rate and a maturity date are really inconsistent with that tax position for the most part, which is this
Right.
is an equity instrument. And in the event the company is sold before the safes convert, they're treated like preferred stock to the extent there already is any preferred stock on the books. They rank what we would call pari passu. With a convertible note, though, that's a debt instrument. And so your qualified small business clocks doesn't start, your long-term
Definitely
capital
not.
gains clock doesn't start. Yeah. And in the event of a liquidation, though, you do rank up there with all other unsecured debt of the company. So, there are pros and cons to the two instruments, but I think the market has gotten comfortable that the safe has more benefits to it. And I think investors, they like it. They're comfortable with it for the most part.
I don't know. Us and most investors we know would rather invest on a convertible note than a safe in
Interesting.
general.
Okay.
However, now that more lawyers like you are going on the record saying, I believe it meets the test of issued stock, because the thing about that makes it better, because paying no tax on your gain starts to outweigh some of these other.
Mm-hmm.
Maybe it comes into play or maybe it doesn't. It definitely comes into play that we start the clock on 5 years, and you can, if we exit in under 5 years, you can tack and roll over, and we can
Right.
always
Yeah.
spin up an SPV for something, and
Yeah.
get us into zero tax territory. So that is a big deal. Now, I've heard some people say that if you read the statutes of the law, it's like 520 or whatever QSBS is. They say this is to create jobs. Okay, this is to create jobs, and lending money that has to be repaid is not our view of creating jobs. If you
Mm-hmm.
wire money to a startup that's a small company that meets all the tests, and that they're going to go take that money and largely spend it on payroll. And so this is, get people working and create jobs. Finally, the politicians doing what they were put there to do. That, but it's got to be primary issued stock from the company. You can't be a secondary. If you're buying stock off of someone and the
Right.
cash goes into the pocket of the founder, not into the treasury of the business, then that doesn't qualify for QSBS. So I think it does. But like you said, YC only introduced it like 6, 7 years ago. And so
Yeah. And to be clear, there,
we're only like 12, 24 months into people taking a QSBS exemption on their gain on a real cash paid out distributed exit. So I think the courts need to adjudicate on it for sure. But I love hearing you say, you're saying, well, it's, the E in safe is for equity.
yeah. Yeah. I mean, to be clear, there's no IRS guidance I'm aware of. There hasn't been a court case, but most people, and I'm not a tax attorney, but most people I talk to are pretty comfortable it's an equity instrument. And that's certainly the position that people are taking these days. But, at some point we'll get definitive interpretation here. But so this is just sort of market positioning right now.
Okay. If it weren't for that, I'd be like, there's no reason to ever do a safe, other than you're screwing your investors. Whereas if your investors care about, if they're American taxpayers, citizens, green card holders, then this is very, very important, and it'll factor into the performance of a fund.
Right.
So let's get into the rough stuff. So what are some of the solutions or common remedies for what gets us into pay to play and pull up and some of these nasty provisions to get deals done as the market goes from really, really boom to we got to come together in the discrepancy of bid ask, and it shows its face in these legals.
Yeah. So what a pay to play is an investor is coming into the company and willing to invest the company. It's often an inside investor, by the way, one of your largest investors. That's sort of the typical scenario we see. And they still believe in the company. They want to put money in, but they don't want to be the only one holding the bag. They think it's fair that other investors around the table pony up their pro rata. And so kind of at its simplest, it is a structure where investors, so existing preferred holders need to invest their pro rata portion of the new round that's coming together. And if they don't, they're penalized. And the sort of typical structure is that if you don't participate, your preferred stock is converted to common stock. And so you still maintain your ownership in the company, but you lose all the benefits of holding preferred stock, right? The liquidation preference, the voting rights, all those bells and whistles. There are a million permutations and combinations of pay to plays and how punitive or not punitive they can be. But at its core, it's really trying to force people to participate and put money into a round that's coming together or be penalized for it. So they're kind of nasty from a morale perspective, right? Earlier investors who maybe just aren't set up to invest more money, will be penalized. And so they're unhappy about that. There are lots of governance issues that come into play because quite often the person leading the pay to play round is often a board member. And so you've got fiduciary duties at play, and you need to make sure you think about the right approvals. So lots of things to think through here. But I pulled a stat before we came in, and it showed that in Q3 of this year, 2% of venture deals that got done had pay to plays in them, which is not a huge number, but I think it was 0% in the last quarter. So there are more of them. I personally have done 2 in the last quarter. As one small data point. So we are seeing them.
Of the 6 investments we made in Q4 of this year, one of them was a pay to play where there was a CVC in the business that had been just completely blocking things. And so this was more of a surgical remove that one investor, from the cap table, basically. But I'll express a concern I have, and maybe even a remedy to my concern, is that in this one company, which is a fantastic company, it's not doing a pay to play because the business is going south. If anything, it's taking off. You had like a corporate venturing business unit that had changed its own staff and were being really evil to the company. And the original champion was just no longer there. And they certainly were not going to put more money in. But there is an individual in Silicon Valley who I won't name, who's a really good friend of mine, a wonderful person who had introduced the deal to us. And it's thanks to that person that we're even in it. So I feel kind of obligated to that guy that he brought us into this startup, which is an amazing company. And then this pay to play came up, and we all understand it. The CEO is a great communicator. But the guy who brought us in was on a different fund. That other fund was fully deployed, and they have a strict policy of no crossing over from funds. So this fund was fully deployed. The new fund, to wire money into the pay to play, would be like a violation of their charter, of what their policy is. And every fund needs a policy on this. And one policy can say, if the startup is through the woods, then why wouldn't I have my Gordon Gecko access? I have like information rights and a pro rata equity right, and and I can participate, and here's the money. We're protected in this pay to play provision. But it was the opposite. So this really wonderful person who had been funding the company at a very early stage before us got completely wiped down. Like, it was like 100 to 1. So if you had $100,000, you basically had $1,000 is what you should be reporting that on your own, LP reports. So I think that the remedy to that is the CEO, and with the support of a subset of the board or investors, say, hey, we want to make this guy whole, right? I mean, that's not what this is about. Let's just issue him with some warrants. Let's issue their fund with some warrants. And just like you're re-upping that ESOP to keep the team motivated and attract and retain talent, I think that people forget that you can just, re-up the stock option plan, and you can, take care of someone that's been a tireless supporter of the company for years.
Yeah. And like I said, that in terms of the team, right, people working at the company, refresh grants and re-ups are almost always part of these pay to play transactions, because you need to re-up people. I think it gets more complicated with your investors, because I think it would probably be difficult to single out one or two investors to make them whole and not do it for everybody who didn't participate. So I'm not saying it's impossible, but I
Yeah.
haven't seen that done, and I think there's lots to think through there. But
It
certainly
wasn't
with the
done.
team,
It wasn't done in this
yeah,
case. Poor
right.
guy.
Yeah, yeah. That it goes to sort of the range of options on these pay to plays, right? The simplest and kindest is just you get converted to common, but it's 1-to-1, so you still own your same percentage in the company. But I have seen over the last few years these nastier ones where you're converting people into a smaller number of shares, and so not only are they losing preferred stock, but they're losing the percentage of the
Oh
ownership they
yeah.
have in the company.
Hell
Yeah.
yeah. I guess, I mean, what's the definition of a pull-up? What does a pull-up mean? Do you know?
Yeah, it just goes to the mechanism by which you affect the pay to play. What the pull up means is typically you convert all the preferred to common stock, and then for those investors who participate, you get pulled back. Your existing the shares you had that were preferred that are now common, they get pulled back up into a new series of preferred stock, shadow preferred we call it. So that's the mechanism by which you make folks whole who participate, and then in addition they get more shares for the new money.
Right.
So it's sort of a tactical mechanism.
Yeah. So in this instance, it was 100-to-1 reduction
Wow.
if you did not wire money and participate. And that was the incentive to get not just the one lead investor who was happy to keep funding the company, but saying, hey, I think everyone should take a bite out of this sandwich and do your fair bit to keep it going. So, and are there any other structures people should know about? I mean, there's structuring period. There's a lot of structuring on secondaries. That's where I've seen kind of some of the most structuring. I think that in the 1990s, we referred to these things as ratchets, and ratchets kind of, I think, went out of fashion because like a ratchet would be we're the founders. It was the .com, heyday. So everything's, you could IPO without any revenue and raise 100 million and so people were saying, oh, we think the pre-money valuation of this company should be $200 million because our revenue is going from 5 million to 50 million this month, and so we're at this huge, run rate or something. And the VC says, yeah, but this funding is happening now. That revenue has not come through. If revenues are 50 million by December 31st, then my investment, will convert in at, a higher valuation. If the revenues fall below 50 million, then I don't just own 10% of the company, I own 20% of the company. So the founder was kind of rooting for, let's hit our numbers. So we only get diluted by 10% from this series A, B, whatever. And the investor has got a perverse incentive for the revenues to fall below. So, I mean, if you were like Lady Gaga and you could tweet, mixing decades now, and bring a lot of, downloads for this app or whatever, she's like, well, maybe I shouldn't promote this on my Twitter account because I want to own 20% by January 1st and I can tweet afterwards, And so I think that those ratchets kind of fell out of fashion. Whereas in the secondary world, you see a lot of structuring. So maybe define structuring, and are you seeing structuring in some of these challenging rounds or maybe not as much, it sounds?
I'm actually not seeing much. I had one deal this year that did exactly what you outlined, where the investor bought it at a certain valuation, and if the company hit or didn't hit a particular revenue milestone over I think it was at the 1 year mark and at the 2 year mark, then the preferred stock got adjusted. And the way you do that is you adjust the conversion ratio to common stock, which effectively means you bought it at a cheaper valuation. So in normal times, right, preferred stock converts 1-to-1, assuming you've not done a down round. But what we said in this deal, and I was representing the investor in this particular transaction, we said, look, if the company does not hit this particular revenue milestone, then the conversion ratio is no longer 1-to-1, right? There was a formula, but every share of preferred converted to more than one share of common. Right. And it was basically a formula that meant the investor had bought in at a cheaper valuation.
It's like an exchange ratio.
Not
Okay, cool. So that gives us a sense of, I mean, the big thing I'm hearing from you is that we're not hearing about a big percentage of these things happening, and it's still a small minority. And it's more of investors and founders and incumbent existing VCs on the cap table agreeing to clean terms, and let's just get a valuation that works. And it's not going into some dark, endless well of sadness, on the legal side. So that sounds good. Why don't we switch gears and talk about secondaries? So, after the dot-com crash and Sarbanes-Oxley, companies were just staying private forever, and they were not IPOing when you expect them to. M&A activity was, not returning portfolios too fast, and it was a necessity to have some sort of secondary transaction. If someone's going to buy shares from an existing investor on the cap table, whether that's a founder, early investor, recent investor, whatever, and the money changes hands and the shares change hands and no money goes into the treasury. So that's a secondary. What are you seeing on secondaries? Or even walk us through the timing of like leading up to the frothy summer of 2021, which was sort of the peak. And where are we now on founders selling secondary shares in the secondary market or investors?
Yeah. So when I first got into this business, I joined Fenwick in 2008. We didn't really see many secondaries, but they sort of became popular shortly after that. And I would say certainly like in 2021 was probably the height in recent times, and there were a ton of secondaries going on. I had seed stage companies getting term sheets, so with that, they've been around for months or less than a year, and investors were putting in a secondary component to make their deal more attractive than the next investor.
Wow.
So a little craziness, I think, by most people's definition. But secondaries fall on a spectrum, right? At one end of the spectrum, you just, let's say, have like one or two founders selling, pretty simple transaction, usually done in connection with the financing. On the other end of the spectrum, we have what we call a broad-based tender offer, which is more than 12 sellers, but potentially hundreds and hundreds of sellers. And those are, more complicated transactions. The securities laws kick in, so there's lots of rules about how you do them. So we see them on a spectrum, but there were a lot of secondaries in 2021. I think most financings had some secondary component, whether that, small group of founders selling or this broad-based tender. We just aren't seeing many of them these days. I have one deal on the go right now with a tender for the executive team, but one of the reasons people did secondaries was to get liquidity into people's hands, like you mentioned, but also there was more demand and capital that wanted to come into the company than there was availability, because the company did not want to suffer the dilution. And so one way you can solve for that is by having existing stockholders sell their shares. We generally don't have that problem in the market now, where there's more capital that wants to come into a company than the company is willing to take in. And so you don't have this overflow of capital, and the need for secondaries to solve that problem. So they'll come back again, but we just aren't seeing many of them right now.
Okay. Yeah. I mean, we get emailed all the time from people saying, I have a secondary seller that wants to sell some of their shares in a company that you are an early investor in. And so we know that you've got information rights. Do you want to buy these shares? And we're seeing it like 86% discount to the summer 2021 financing. And we're thinking, should we use that as, a markdown for the share price that we're using? And we're thinking it's like some employee who's leaving the company who has no other option should be talking to the ESO guys,
Yeah.
But I think that in the secondary market, what we've seen kind of since the, kind of Putin invasion crash of kind of March, April of 2022, where like people got the memo by end of August that this is totally good deals should be done at a more reasonable level. And so the fall was much more rational. But like when the stock market crashed, then it was like everybody woke up to it. But there's still like takes a while for a company that's used to raising at $1 billion valuation to consider issuing stock or selling on the secondary market at such a come down from that price. And so they just say, I'll just sit and wait to grow into this valuation kind of thing.
Right.
I mean, you almost see it in housing where interest rates have gone up. And so there's just not as many houses in the market or transactions being done, because like the seller is thinking this and the buyer is thinking that, and they're just not meeting. They're just not meeting.
Yeah.
So I think that secondary market, has taken a bit of a pounding. And And it's probably a tale of two cities. There's always some company that, regardless of the macro environment, their business is just flying off the hook and everyone wants to be on that cap table, and
Right.
you see some of it. But so secondaries will come back. I agree with you. Culturally, it was, I think, embraced more on the West Coast than the East Coast. And the East Coast kind of said, I'm not letting that founder get paid before I do kind of attitude. And the West Coast was thinking, well, this person's on their third divorce. Let's stop the let's stop the bleeding for this person and let them get a cabin in Tahoe. It's not going to be the end, you know.
Yeah, I mean, I sort of come around to that view as well, because I think the last thing you want is a founder who's just distracted by his or her finances, or stressed out, right? And I think, at least in the earlier days, the view was, let's get some comfort money into the founder's hands, right? To allow them to buy a house, put away money for their children's education, kind of solve the basics so that they are really comfortable, not too comfortable, comfortable enough that they're not worrying about, paying bills. Um, that was kind of the early thinking, that actually wasn't the investor's interest, not to have a founder who was distracted by his or her finances. I think we've seen that change, where a lot of founders have taken a lot of money off the table.
That's right.
Yeah.
Yeah, I mean, we've seen founders become investors, and now
Right.
they're running around Silicon Valley and San Francisco, taking a lot of meetings, deploying capital that they obtained from secondary sales. And
Mhm.
I'd rather see them just in the office, undistracted by that completely. And then we've seen founders that took so much money off the table during these peak demands and very high valuations that they are enjoying being CEO, enjoying having all the money they need. And there seems to be no incentive for them to go public or actually sell the company and decide, what am I going to do when I'm not CEO of this company? That's not apparently obvious to everybody, what their next move would be. We're not all Jack Dorsey's with yet
Right.
another hit record waiting. So, I think at the end of the day is secondaries make sense in specific situations, and there should be analysis on every single one as an individual idiosyncratic operation of, how is this personality going to deal? It's kind of like the young rapper or athlete gets like a $90 million contract and then gets like 5 DUIs in a week. It's just not
Right.
everyone responds well to a big bank account blow up. So it should be a little sensitive on it. In a perfect world, you're just improving the outcome for everybody by removing problems, solving problems, and saying, hey, if I just sold 10% of my shares and I got that much money out, then I'm definitely understanding, and my spouse appreciates what the 90% is worth and the sacrifices that are going to be made over the next 5 years. So it's kind of a tricky thing. It's kind of a tricky thing. Well, so maybe on closing out, predictions for 2024. What are we going to see in the ebb and flow
Mhm.
of the market, which gets truly spoken in truth in the legals that Fenwick is drafting?
Yeah, I mean, so I sit in all my clients' board meetings, and I hear a lot from investors in terms of what they're seeing and what they're thinking. I think, unfortunately, and this is just my prediction, I think 2024 will be much of the same. I think it's going to be another kind of slow year, but I'm optimistic that kind of in Q4 we'll sort of start to climb out of this, and I think 2025 is going to be a good year again in the tech world. So that's my personal prediction.
Okay, and so I guess you probably answered the question. So that's fundraising, but what about exits? When the hell are we going to get our money back? Because people kind of say like, well, if Zoom was valued at 47x revenue, like it would take you 47 years to get your money back with no discount or time value of
Right.
money. I mean, that's
Right.
insanity. But that they're afraid of selling at these lower current market multiples. When do you think that we're going to see sensible M&A, or even, what are your thoughts on IPOs for 2024? We've got like 60, 70 portfolio companies. I would love to, start returning the cash and stop talking about the total value to paid in.
Yeah, I think probably a similar timeline. I think we have a number of companies, some of them are our clients, who are kind of eager to go public, and they're keeping things warm so that they're ready to go. But I think most folks think it's like at least a second half of Q4 of 2024 thing. So I think you'll see a similar timeline for M&A and capital markets activity.
Okay, so maybe a good time to be investing now if
That's right. Yeah.
if we're not that far. That's definitely what I would hear talking to you. Well, Kristine, thank you so much for being part of our legal series. Great to talk to you, and hope to see you in Menlo Park, New York, in the real world sometime very soon.
Yeah. Happy holidays. Bye.
Okay, you too. Bye for now.